The physical production of commodities is inherently vulnerable. A sudden drought, a late freeze, or a flooded harvest can trigger extreme price volatility, creating immense financial exposure for both the producers growing the raw materials and the industrial buyers who rely on them. Historically, businesses managed this volatility by entering into an over-the-counter, or OTC, forward contract. This is a private, bilateral agreement to deliver a specific quantity of a commodity at a specified time in the future at a price negotiated and locked in today. However, the forward contract suffers from a critical structural weakness: counterparty credit risk. If the prevailing spot price drops severely before the delivery date, the buyer is heavily incentivized to walk away from the inflated contract price. A single default can trigger a domino effect through a supply chain. Exchange comparison data reveals a second major flaw. OTC forward contracts are completely customized, making them difficult to trade and carrying high credit risk. You are locked in until maturity, rigidly obligated to give or take physical delivery of the goods. Without a central guarantee against default and a mechanism to exit positions early, these contracts cannot support the scale of global hedging. The market required a structural evolution. The exchange-traded commodity futures contract was engineered specifically to solve the failures of the OTC forward. First, the exchange removes all customization. As outlined in the exchange specifications, every futures contract dictates uniform, non-negotiable lot sizes, tick sizes, and rigid quality grades to create a tradable unit. Second, the exchange severs the direct bilateral relationship by introducing a clearing corporation. Through novation, this central counterparty steps in, becoming the buyer to every seller and seller to every buyer. If a participant defaults, the clearinghouse absorbs the impact, shielding the network. To fund this guarantee, both participants must deposit a strictly calculated fraction of the total contract value, known as the initial margin, before executing a trade. The clearinghouse enforces daily mark-to-market settlements. Every trading day, open accounts are mathematically adjusted, debiting losses and crediting gains, based entirely on official closing prices. By isolating and managing the financial risk separately from the physical goods, participants are free to trade the price volatility alone. As a result, only a small fraction of futures contracts ever culminate in actual physical delivery. By enforcing strict standardization and removing counterparty credit risk, the exchanges created a liquid instrument that allows purely financial participation. Every futures price is anchored to the physical spot market through a specific mathematical relationship. This tether is defined by the cost of carry model. It links the current spot price of a physical commodity to the contract price for its future delivery. The baseline equilibrium relies on two variables: the spot price, S, and the cost of carry, C. The cost of carry is the financial reality of holding inventory. Buying physical wheat today for future delivery incurs warehouse fees, insurance, and ties up capital. Because holding these physical commodities cost money over time, the futures price naturally trades at a mathematical premium to the spot price to account for those expenses. When the market operates in this normal, upward-sloping state, where the future delivery price is higher than the immediate cash price, it is known as contango. In a contango market, the premium you pay for a futures contract is the cost of paying the market to store and insure the physical commodity on your behalf. The physical world is volatile. A sudden geopolitical shock or an immediate spike in industrial demand can trigger instant scarcity in the supply chain. Sudden scarcity introduces a specific variable into the pricing equation, the convenience yield, Y. As detailed in the calculation here, the futures price is now the spot price plus the cost of carry minus this new variable. The convenience yield is the financial value placed on holding actual physical inventory right now, rather than a paper contract for future delivery. If an assembly line requires raw materials today to avoid a shutdown, the immediate physical stock holds immense overriding value. We can observe this dynamic using the NISM Guarci data. In this scenario, the current spot price is 6,000 rupees per quintal. The physical storage and risk costs total 200 rupees. But due to extreme export demand, the market places a convenience yield value of 300 rupees on immediate inventory. Running the formula, 6,000 spot price plus 200 carry cost minus 300 convenience yield. The immediate physical need outstrips storage costs, dropping the futures price to 5,900. The market has inverted, trading at a discount to the spot price. This state is known as backwardation. Backwardation is a quantitative distress signal. It is the open market stating that physical supply is critically strained, incentivizing participants to sell their physical inventory immediately to capture the high spot price, rather than storing it for the future. Whether a commodity is trading in contango or backwardation, the pricing mechanics shift as the futures contract moves towards its final expiration date. To measure this shift, we look at the absolute numerical difference between the current physical spot price and the paper futures price. This measurement is known as the basis. As the contract approaches expiry, the law of convergence takes effect. The variables dictating the basis, the cost of storage, and the convenience yield, are tied to time. As time runs out, they evaporate. At expiry, there is zero time left to store goods. Therefore, futures prices must perfectly converge with the physical spot price. To execute this final settlement, exchanges utilize a spot price polling mechanism, aggregating data directly from physical markets to ensure the final convergence price is accurate. Because this convergence is a mathematical certainty, commercial businesses can lock in prices months in advance, knowing that the paper contract will exactly mirror the physical reality on the day of delivery. Market participants utilize this predictable convergence by taking buy or sell positions based on their physical market exposure. As shown in the exchange guidelines here, these positions carry explicit daily margins and settlement obligations. A buyer takes a long position to lock in a price. If the market rises, the contract increases in value, generating profit. A seller takes a short position to lock in a sale price. If the market falls, the position gains value, capturing profit. For commercial hedgers, the farmers, miners, and manufacturers, this is the objective. They take futures positions so any financial loss in their physical supply chain is canceled out by the corresponding gain in their derivative payout. Conversely, speculators assume this transferred risk purely for financial return. By taking the opposite side of these commercial trades, they provide the liquidity required for hedgers to enter and exit their positions efficiently. Driven by central clearing guarantees, cost of carry mathematics, and the certainty of convergence, commodity futures operate as engineered risk transfer mechanisms, providing the structural stability required to run the physical economy.